Are you prepared for the looming recession that's being forecasted by top economists? Because getting ready now can be the difference between financial ruin and stability. In this video, we'll be going over essential money tips that will help you recession-proof your finances. If you're new here, consider subscribing for more personal finance and investing content. With the global economy experiencing fluctuations, it's normal to feel uncertain about the future. But one thing's clear: being proactive is key. Many people assume they can simply ride out a recession, but those who do often come out the other side with financial scars that can last for years. The good news is that there are steps you can take to shield yourself from the negative impacts of a recession. Whether you're a seasoned investor or just starting out, understanding these money tips can be the difference between losing everything or emerging from a recession even stronger. Expanding your knowledge on personal finance is crucial in today's complex economic landscape. This can be achieved through enrolling in online courses, reading books, or attending financial seminars. Staying informed will empower you to make more informed decisions about your financial future. Ensure that you have a clear understanding of the fees and terms associated with each financial product or service you use. By having this knowledge, you'll make better informed decisions, leading to greater financial stability and success. In addition, aim to prioritize needs over wants to optimize your financial progress. Having a solid grasp of personal finance concepts can help you navigate various financial instruments and avoid potential pitfalls. It is essential to comprehend the concept of compound interest, for instance, to make the most out of your savings or retirement accounts. Similarly, understanding the benefits and drawbacks of different investment options, such as stocks, bonds, and mutual funds, can aid in creating a diversified investment portfolio that aligns with your long-term financial goals. Furthermore, being aware of tax implications and how to optimize your tax strategy can result in substantial savings over time. Building a solid foundation in personal finance can also help you manage debt effectively by identifying debts with high interest rates and focusing on paying those off first. Developing a well-thought-out budget is another vital aspect of personal finance. Start by categorizing your expenses into needs and wants, and then allocate your income accordingly. Be sure to include a contingency fund in your budget to account for unexpected expenses or financial emergencies. By regularly reviewing and adjusting your budget, you can identify areas for improvement and make necessary adjustments to stay on track. Moreover, adopting a long-term perspective when making financial decisions can help you avoid common pitfalls, such as lifestyle inflation, and stay focused on your financial objectives. A well-structured budget can also enable you to save for specific goals, like a down payment on a house or retirement. You can achieve this by setting aside a certain percentage of your income each month and automatically transferring it into a savings account. To further enhance your financial acumen, consider seeking guidance from a financial advisor or planner. These professionals can offer valuable insights and provide tailored advice based on your individual financial situation and goals. Working with a financial advisor or planner can also help you avoid costly mistakes and stay up to date with the latest developments in personal finance. Furthermore, they can aid in creating a comprehensive financial plan that addresses all aspects of your financial life, from saving and investing to tax planning and retirement. By leveraging their expertise, you can gain a deeper understanding of personal finance and make more informed decisions about your financial future. If you're serious about achieving financial freedom and want to discover the steps to financial freedom, start now and transform your mindset with the Modern Millionaires. Link in the pinned comment, and be sure to watch until the end of this video for actionable tips and strategies. Embracing a culture of continuous learning is essential for achieving and maintaining financial stability. Staying informed about market trends and developments can help you make more informed investment decisions and avoid potential pitfalls. Reading financial news and articles, participating in online forums, and attending seminars or workshops are just a few ways to stay informed and expand your knowledge. Additionally, joining a community of like-minded individuals who share similar financial goals and values can provide valuable support and motivation. By cultivating a culture of continuous learning, you can stay ahead of the curve and make the most out of your financial resources. By creating a customized financial plan, you'll have the opportunity to thoroughly assess your financial landscape, acknowledge areas for improvement, and execute strategies that effectively allocate your resources. Furthermore, utilizing technology, such as mobile banking apps or automated savings tools, will empower you to promptly address any imminent financial challenges that may arise. Incorporating a system of scheduled revisions to monitor your financial progress and receive reminders about upcoming bill due dates will lead to more astute decision-making, allowing you to gradually build wealth, thereby mitigating avoidable debts, increasing overall financial resilience, and ultimately fortifying your savings. Moreover, you can reassess your spending habits and amend any unnecessary expenditure, allowing you to allocate a greater proportion of your income towards achieving your principal financial objectives. Streamlining financial transactions and minimizing unnecessary outlays is undoubtedly a pivotal step towards ensuring financial prowess and setting the foundation for a stable future. Understanding the full scope of economic factors at play in the arena of global markets can aid investors in accurately identifying potential risks while establishing a framework to minimize those risks and mitigate any losses that may occur. Given the challenges inherent to making informed investment decisions, effectively addressing market fluctuations is critical for safeguarding one's investments. A report published by Charles Schwab, in which the data of numerous investors was compiled and analyzed, demonstrated that individuals who diversified and spread their investments across multiple different financial streams during the financial downturn were better poised to weather its influence than those who had an undiversified portfolio. It is crucial for investors to incorporate diversification as a central component of their investment strategy to cultivate an improved level of resilience in response to the inherent uncertainty that accompanies participation in financial markets. Analyzing historical market trends through empirical research has made apparent that prudent investors implement varied techniques that ultimately culminate in financial protection. Of the most viable methods of safeguarding investments and increasing the potential for financial solvency are including the formulation of distinctive strategies that allow investors to modify their portfolio composition according to shifting economic indicators. At times, such adaptations must be made proactively to avoid perpetuation of circumstances that lead to otherwise unforeseen losses. Of unquantifiable value to well-regarded financial visionaries is a critical review of various indicators that might possibly signal the imminence of market disturbance. Individuals who manage this oversight successfully may execute necessary maneuvers, comprising sound and responsive actions, providing greater insight, and cultivating key alliances to extend support networks for continued market participation. With expanding knowledge in personal finance, forging a fortified and stable economic base facilitates planning effectively and securing key areas such as retirement savings, fixed income provisions, student debt repayments, and wealth acquisition amongst myriad of other possible ends. Taking financial development to the subsequent stage entails unearthing hidden markets containing low costs, lower leverage funds, long-term perspectives, and an aggressive portfolio containing asset assortment. Cultivating deep monetary understanding requires ongoing education in accounting, stock markets operations, investment strategies, and others. As soon as understanding exceeds a threshold where concepts can easily interlink forming mental models, implementation begins, resulting in the creation of economic safety. An account where you can store your emergency fund, such as a high-yield savings account, can offer higher interest rates than a traditional savings account, allowing your money to grow over time, albeit at a moderate pace. And if you're an investor, it might be a good idea to consult with a financial advisor to determine if it's time to rebalance your portfolio, ensuring you're diversified and aligned with your long-term goals. The process can involve a thorough examination of your current investments, including stocks, bonds, and other assets, and making adjustments as needed to ensure your portfolio remains aligned with your risk tolerance. For those who struggle to save due to irregular income or limited financial resources, exploring alternative savings options such as micro-savings apps or community-based savings programs can be beneficial in getting started. Many of these programs offer low or no fees, and some even provide incentives for consistent saving. Similarly, online savings accounts often have lower fees and higher interest rates compared to traditional brick-and-mortar banks, making them an attractive option for those looking to save and grow their money. Reducing debt is another crucial aspect of fortifying your financial foundation, requiring discipline and patience. Creating a comprehensive list of all your debts, including credit card balances and loans, can help you visualize your financial obligations and prioritize them based on interest rates, outstanding balances, or other factors. From there, you can begin to develop a plan to tackle your debt, whether that involves consolidating your debts into a single loan with a lower interest rate, negotiating with your creditors for temporary hardship programs or reduced payments, or simply chipping away at your balances one by one. Additionally, building an emergency fund can help alleviate stress when unexpected expenses arise, providing a cushion against financial shocks that might otherwise force you to take on more debt. This fund should ideally cover 3 to 6 months of living expenses, giving you time to adjust to any changes in your financial situation without having to rely on credit cards or other forms of debt. Moreover, debt reduction strategies should involve developing a long-term plan, taking into account your overall financial goals and priorities, and focusing on high-interest debts first to maximize your savings over time. Investing wisely is also essential for long-term financial stability, requiring both knowledge and discipline. Avoid putting all your eggs in one basket by diversifying your investments across different asset classes, such as stocks, bonds, real estate, and commodities, to help minimize your exposure to market volatility and ensure that your portfolio remains aligned with your investment goals. Consider working with a financial advisor to create a customized investment strategy that takes into account your risk tolerance, investment horizon, and other factors. This can help you create a tailored plan that helps you make progress toward your goals while also minimizing your risk of losses. Moreover, consider dollar cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of the market's performance, to help you navigate the ups and downs of the market and reduce your risk. Furthermore, tax-efficient investing is another important consideration. Aim to minimize your tax liability by holding tax-efficient investments, such as index funds or municipal bonds, in taxable accounts, and aiming to maximize your after-tax returns. When evaluating investment options like dividend-paying stocks, real estate investment trusts, REITs, or peer-to-peer lending, and weighing the potential risks and rewards associated with each investment. Understanding your financial objectives and creating a tailored strategy will also help you navigate the world of personal finance. To achieve this, begin by identifying specific objectives, such as saving for a down payment on a house or retirement. Assess the time horizon for each goal and create a plan to achieve it. Consider seeking guidance from a financial advisor or planner to receive expert advice on reaching your financial goals. Educating yourself on the subject is essential. You can do this through online resources, books, or courses. As you gather more knowledge on personal finance, you'll be better equipped to make informed decisions about your financial future. Moreover, having a long-term perspective will enable you to weather market fluctuations and stay on track to achieving your financial objectives. Investing in a diversified portfolio will help you spread risk and increase potential returns. Exploring various asset classes such as stocks, bonds, and commodities can provide a comprehensive approach to investing. Furthermore, consider exploring international investment opportunities to expand your portfolio's scope and reduce reliance on domestic markets. Stay up to date with market trends and be willing to rebalance your portfolio as market conditions change. This proactive approach will help you capitalize on new investment opportunities and minimize potential losses. Another essential aspect of financial planning is managing debt and building an emergency fund. Developing a debt reduction strategy, such as consolidating high-interest loans or creating a debt repayment schedule, will free up more money in your budget for savings and investments. Having an easily accessible savings cushion will also provide a safety net during unexpected financial setbacks, allowing you to avoid going deeper into debt. To build a robust emergency fund, set aside 3 to 6 months' worth of living expenses in a readily accessible savings account, ensuring that you're prepared for unexpected expenses or financial downturns. To implement an effective financial plan, emphasize the importance of regular monitoring and adjustment. Establish regular checkups with your financial advisor or planner to assess your progress towards your financial objectives. Conversely, if you're handling your finances independently, set aside time to review your budget, income, and expenses to identify areas for improvement. This will also enable you to make adjustments as your financial circumstances change, ensuring you stay on track to achieving your long-term financial goals. A flexible approach to your financial plan will ensure that you remain adaptable to changing market conditions, economic fluctuations, and personal financial situations. One step you can take immediately is to review your budget and identify one area where you can cut back. It might be as simple as cooking at home instead of ordering takeout, or finding ways to lower your household expenses. Another practical tip is to consider opening a high-yield savings account to earn higher interest on your money and grow your savings faster. Moreover, harnessing the power of compound interest can significantly boost your long-term savings. This involves starting investments early, being consistent, and letting time work in your favor. When it comes to long-term investments like retirement accounts or savings goals, it's essential to avoid making impulsive decisions based on short-term market fluctuations. Avoid emotional decisions like panic selling during downturns, and instead focus on steady growth and consistent contributions to your investment portfolio. By combining compound interest with time and consistency, you can turn small, regular investments into substantial long-term gains. Investing a fixed amount of money at regular intervals, regardless of the market's performance, to reduce timing risks. Beyond these core investment strategies, incorporating environmental, social, and governance (ESG) factors into your investment approach may also help you build a more sustainable financial future while making a positive impact on society. This way, you can ensure that your investments are aligned with your values and promote more sustainable business practices, while also enjoying the benefits of a well-diversified portfolio. Furthermore, ESG-focused investing often contributes to more stable long-term returns as companies adhere to rigorous standards of sustainability and responsibility, ultimately enhancing their resilience and competitiveness in the market. Some of the key ESG considerations include evaluating a company's climate policies, labor practices, board composition, and community engagement, all of which can impact its long-term growth prospects and financial health. Establishing multiple income streams can also play a vital role in strengthening your financial resilience. This might involve pursuing a side hustle or freelancing in addition to your primary job, investing in dividend-paying stocks or peer-to-peer lending, or even generating passive income through renting out a spare room or property. To successfully navigate multiple income streams, it's essential to stay organized, track your income and expenses carefully, and maintain a clear understanding of your tax obligations. Moreover, be sure to continually assess your income streams to ensure they remain aligned with your financial goals and risk tolerance. By diversifying your income sources, you can create a more stable financial foundation and reduce your reliance on a single income source. Another critical aspect is ensuring your emergency fund is well stocked in case you encounter any turbulence with your income streams, thereby minimizing your financial stress and uncertainty. Aim to maintain an easily accessible savings fund that covers at least 3 to 6 months of essential living expenses. In today's rapidly changing economic landscape, cultivating healthy financial habits requires discipline and patience. Make a commitment to regularly review your budget, investments, and debt, and adjust your strategy as needed. Consider automating your savings and investments to make it easier to stick to your plan and avoid making impulsive financial decisions based on emotions. Staying informed about personal finance and economy can also help you stay ahead of the curve. Follow reputable news sources and consider taking courses or attending workshops to improve your financial literacy. Developing a comprehensive understanding of financial markets and regulations will enable you to make more informed investment decisions and effectively manage your financial risks. Moreover, maintaining a flexible mindset will allow you to adapt to shifting economic conditions, regulatory changes, and industry trends, all of which can significantly influence your financial success. Getting your finances in order is a critical step, but effectively maintaining them over time requires an often overlooked component: understanding your personal relationship with money. Recognizing your values, goals, and motivations can help you make more conscious financial decisions that align with your priorities and contribute to a more fulfilling life. To successfully manage your finances, it's essential to adopt a long-term perspective and focus on developing healthy habits that will serve you well throughout your life. Consider consulting with a financial advisor who can help you identify your objectives, create a customized financial plan, and provide ongoing guidance and support to ensure you're reaching your goals. This collaborative approach will enable you to harness the full potential of your financial resources and achieve lasting financial stability and peace of mind. Ongoing adjustments to your spending habits and investment strategies can help ensure long-term financial health. Your allocated savings can be channeled into tax-advantaged retirement accounts, such as a 401k or IRA, which allow your money to grow tax-free over time. It may also be beneficial to consult with a financial advisor to get personalized advice on navigating the complexities of your situation. When evaluating your investments, prioritize a long-term perspective over short-term gains, recognizing that market fluctuations are an inherent aspect of investing. Educating yourself on the various investment products available, such as index funds, exchange-traded funds, and mutual funds, will allow you to navigate the complex investment landscape with greater confidence. Investing in dividend-paying stocks can also provide a relatively stable source of income, helping to offset market volatility. To achieve further diversification, allocating a portion of your portfolio to international stocks or emerging markets can provide exposure to different regions and industries, potentially mitigating domestic market risks. Ultimately, achieving financial stability requires discipline, patience, and an ongoing commitment to managing your finances effectively. Regularly reviewing and adjusting your spending habits and investment strategies will help you stay on track and adapt to changing circumstances. While unexpected events may occur, having a comprehensive understanding of your financial situation and a well-thought-out strategy will allow you to respond more effectively, thereby reducing financial stress and promoting long-term financial health. Further, adapting to changing market conditions is critical to the long-term success of your investments. Active tax management can be a key aspect of overall investment strategy. Tax loss harvesting, which involves offsetting realized capital gains with losses, can help to reduce tax liabilities, leaving more money in your portfolio to continue growing. Moreover, automating key financial processes, such as transferring funds into savings or investment accounts, can simplify your financial management, freeing up time to focus on higher-level issues. Investments based on emotions rather than investment strategy often result in buying high and selling low. Avoiding this type of market timing approach will help you achieve more reliable and sustainable investment performance in the long run. With a solid understanding of your investment strategy, the necessary tools, and a long-term perspective, it's possible to navigate the inevitable market fluctuations and stay the course towards your desired financial goals. Inflation has also a significant impact on investments, and as such, investors also have to keep track of inflation expectations as it impacts every aspect of an investment portfolio. Furthermore, they need to define inflation-indexed objectives for each investment strategy. This knowledge also helps investors in identifying any shifts in their financial goals, as well as to implement the most effective and flexible investment policy management process. Moreover, a well-structured investment strategy takes into consideration the specific needs and constraints of each individual investor, including their current financial situation, risk tolerance, and investment horizon. By understanding these factors, investors can make informed decisions about the types of investments that are best suited to their needs and develop a comprehensive plan for achieving their long-term financial objectives. Some investors also tend to focus primarily on the potential risks and return-based targets when evaluating their investments and potential exposure to market downturns and other risks, without considering how this exposure might impact their overall goals and priorities. A complete investment strategy combines these four key components: an understanding of overall goals and priorities, the approach to manage risks, a strategy for combining assets, and plans for adjusting strategies over time as circumstances change. In this context, effective portfolio management involves the selection of a diversified mix of assets that aligns with the investor's goals and risk tolerance. This may include a combination of stocks, bonds, and other investment vehicles, each of which offers a unique set of benefits and risks. By spreading investments across different asset classes, investors can reduce their overall risk exposure and increase the likelihood of achieving their long-term financial goals. Staying on track requires making continuous decisions about every part of your investment strategy, adjusting your policies, asset mix, and manager choices in response to market trends, changed goals and preferences, and the financial climate in general. A crucial aspect of a successful investment strategy is the ability to adapt to changing market conditions and economic trends. Investors must be willing to adjust their strategy as needed in response to shifts in the market or changes in their personal financial circumstances. This requires a high degree of flexibility and a willingness to make tough decisions when necessary. In some cases, this may involve taking a contrarian approach, where investors are willing to go against the crowd and make investments that may be unpopular at the time, but have the potential to deliver strong returns over the long term. In other cases, it may involve taking a more conservative approach, where investors focus on preserving their capital and minimizing their exposure to risk. Whatever the approach, the key is to remain focused on the investor's long-term goals and to make decisions that align with those objectives. Another important consideration for investors is the role of taxes and fees in their overall investment strategy. Taxes and fees can have a significant impact on investment returns, and investors must be aware of these costs when making their investment decisions. For example, investors may choose to hold tax-efficient investments in taxable accounts, while holding tax-inefficient investments in tax-deferred accounts. Similarly, investors must be mindful of management fees and other expenses associated with their investments, as these costs can eat into their returns over time. By taking a tax-aware and fee-conscious approach to investing, investors can help to maximize their returns and achieve their long-term financial objectives. This requires a high degree of discipline and a willingness to make informed decisions about every aspect of their investment strategy. Investors must also be aware of the importance of risk management in their investment strategy. This involves identifying potential risks and taking steps to mitigate them, where possible. For example, investors may choose to diversify their portfolio across different asset classes, sectors, and geographic regions in order to reduce their exposure to any one particular risk. They may also choose to use hedging strategies or other forms of insurance to protect their investments from potential losses. Whatever the approach, the key is to remain focused on the investor's long-term goals and to take a proactive approach to managing risk. By doing so, investors can help to ensure that their investments are aligned with their objectives and that they are well positioned to achieve their desired returns over the long term. If you're serious about protecting your finances during the next recession, now's the time to take action. Don't wait until it's too late, and make sure to follow these vital money tips. As always, like and subscribe for more videos on personal finance and investing. And if you enjoyed this video, share it with a friend or family member who might benefit from this information. If you have any questions or comments, be sure to leave them in the section below. Thanks for watching.